half of all American families headed by someone aged 65 to 74 have a net worth above $409,900. The other half sit below it. And before that number sends you anywhere, net worth means everything you own minus everything you owe. The house counts, the mortgage comes off. It is not a bank balance, and mistaking the two puts you a whole level out. That figure comes from the Federal Reserve's Survey of Consumer Finances, the government's own household wealth study. The 2022 survey is the most recent one published, so the wealth numbers are in 2022 dollars. Every tax and Medicare rule you hear is current for 2026. 4 dividing lines cut American families into 5 levels: $27,100, $192,900, $658,900, and $1,938,000. Hold your number against those 4 and you have your level. What makes it worth knowing is not the ranking. It is that a different rule starts to bite at each one. None of them is exclusive to a single level, but each has a level where it begins to cost or save real money. Level 1 is everything below $27,100. Across that bottom quarter, the median net worth is $3,500. Social Security is the income with no portfolio to manage. As of July 2026, the average retired worker's benefit is about $2,086 a month. The standard Medicare Part B premium for 2026 is $202.90. That is close to $1 in every 10 of that check, and it usually comes out before the money reaches you. The 2026 cost of living adjustment was 2.8%, about $56 a month for that average worker. The Part B increase took $17.90 of it. About $38 survived. There is a protection here that most people never hear about. Under the hold, harmless rule, if your premium is deducted from your benefit, a Part B increase generally cannot push your net check below last year's. And if income and resources are low enough, a Medicare savings program can pay the premium outright, while extra help covers most drug costs. The income and resource limits vary by state and they change every year, so check rather than assume. Between $27,100 and $192,900, you are in Level 2. Usually that is a house with some equity and a modest retirement account. What arrives here is tax on your Social Security. The test is something called provisional income. That is half your Social Security plus all your other income, including tax-exempt interest. Once it passes $25,000 filing single or $32,000 married filing jointly, part of your benefit becomes taxable. Past $34,000 single or $44,000 joint, up to 85% of it can be taxed. Those 4 figures were set in 1983 and 1993, and they have never been indexed to inflation. They do not move. Your benefit does. If you are still working and claiming before full retirement age, a second test applies. Full retirement age is 67 for anyone born in 1960 or later. In 2026, $1 is withheld for every 2 you earn above $24,480. Those dollars are not lost. At full retirement age, your benefit is recalculated to credit the months withheld. Level 3 runs from $192,900 up to $658,900. That opening figure sits inside this band, $409,900. $6,900 for families aged 65 to 74. The median before tax income there is $60,900. Here, which account the money comes out of matters more than the balance. For 2026, a married couple filing jointly gets a standard deduction of $32,200. Once both are 65, add $1,650 each. Then add the new senior deduction of $6,000 each, which runs through 2028. Stacked, that is $47,500 before a single bracket applies. Filing single at 65 or older, the same stack comes to $24,150. That senior deduction phases out above $150,000 of modified adjusted gross income for a couple, $75,000 single. For most retirees, that is simply the adjusted gross income line on the return. Long-term capital gains are taxed at 0%, up to $98,900 of taxable income for that couple. If your situation looks like this, that room is worth the most in the years before required minimum distributions or RMDs begin. For most people retiring now, that is age 73. Born in 1960 or later, it is 75. Cross $658,900 and you are in level 4. This is where Medicare starts reading your tax return. The income-related monthly adjustment amount, or IRMAA, is a surcharge on your Part B and Part D premiums. For 2026, it begins above $109,000 of modified adjusted gross income filing single, or $218,000 married filing jointly, and it uses your 2024 return, a 2-year look back. It is a cliff, not a slope. $1 over the line adds $81.20 a month per person. For a couple, that is about $1,949 over the year, before the Part D surcharge. A Roth conversion or a large capital gain can arrive as a Medicare bill 2 years later. Above $1,938,000, you are in the top 10% of American families by net worth. A paid-off house in an expensive county plus a retirement account can carry a household over that line. IRMAA's top tier starts at $500,000 single, $750,000 joint. There the Part B premium reaches $689.90 a month. And the question quietly shifts from spending to transferring. For 2026, the federal estate tax exclusion is $15 million per person. A married couple can shelter $30 million between them, but only if the surviving spouse claims the unused portion. And that requires filing an estate tax return on time, even when no tax is owed. So do the arithmetic tonight. Everything you own minus everything you owe held against those 4 numbers. Then take the one rule that governs your level and check it against last year's tax return or your Medicare statement. Not one of these levels is a verdict on you. The level only tells you which rule is doing the most work in your money right now. Thank you for watching all the way to the end. If this video gave you something to think about, do one small thing. Subscribe to Retirement Decisions Desk. Every video here unpacks one retirement decision, and subscribing is how you'll never miss the next one. Take care of yourself, and I will see you in the next video.